Hey, Kyle here with winthehouseyoulove.com. Today we're talking about how do you pay off your mortgage early. So nobody wants to have a mortgage payment, right? It's something that it seems like it's inevitable. It seems like it may never go away, but you actually can pay down your mortgage pretty quickly. I know it can feel overwhelming sometimes, but I want to talk through some myths about paying off your mortgage early. There seems to be a lot of weird ideas that people put out there. Things like if you make one extra mortgage payment, you're all of a sudden going to pay off your mortgage by 7 years early. So it doesn't really work like that. We're going to talk through some different strategies and how you can find extra money to pay off your mortgage early. So one thing we need to know is that there is no magic solution here, okay? We took out debt, and that debt has to be paid back. It's as simple as that. There aren't tricks and strategies to get rid of the debt and make it disappear without paying for it. If that existed, the banks would figure it out and make it so that that doesn't exist anymore, right? If you take out $100,000 in debt, you need to pay back $100,000 for the debt to go away. So there are a lot of myths around because we're always looking for that solution. How can we get rid of it earlier? Unfortunately, there's no magic bullet that's going to take care of our mortgage and pay it off for us. We need to do that. So we need to be proactive in figuring out how we're going to pay it down. So there are 2 steps to paying down your mortgage. Number 1 is we need to budget to find the extra money each month that we can put into the mortgage payment. And then number 2 is we have different strategies we can use to pay down the mortgage a little bit faster than we were beforehand. So step number 1 is to budget to find extra money. So you might be using a budget right now, and if you are, that's fantastic. If you're not, you will save so much money by getting a really defined budget. And what I mean by a budget is not an expense report. See, there are apps like, maybe it's changed, but I know when I used Mint, all I felt like they did was give me an expense report at the end of the month. So instead, I use a tool called You Need a Budget. It's called a YNAB, so ynab.com or youneedabudget.com. And it's a budgeting tool where basically I can consult my budget on my phone before I go spend money. So if I'm about to go out to eat somewhere, I can check my eating out category and see how much money do I have. Can I afford to spend this? And so each month I know what to expect. I have this money set aside already. So that way I have extra money coming in, and it's zero-based budgeting. So basically you're not forecasting your income. All you're doing is budgeting the money that you have. So this helps you figure out the extra money that you have and where you're spending way too much money because you have to categorize every single thing. Now you can use a bunch of other tools. You could use an Excel spreadsheet if you wanted to. But if you're going to budget, I would highly suggest budgeting manually. Don't do the auto transactions because that's just going to make it feel like an expense report. You're going to look at it and say, oops, I spent this much money on food, or oops, I spent this much money on entertainment. A budget needs to be something that you consult before you spend that money so you know where everything's going. Something else you can do if you're kind of struggling to figure out what to do on a budget is look into some of Dave Ramsey's stuff. He has a book called Total Money Makeover that's really fantastic. And what I like about Dave Ramsey, he can be a polarizing person, first of all, but what I like about him is that he helps you get focused on what you're doing with your money. Because it can be extremely difficult to, you're focusing on paying down debt, you're increasing savings, you're focusing on your retirement, you're also focusing on paying on a mortgage or school for your kids, or you name it. We're always trying to put money in different places, and it can feel super overwhelming because I have money here and there and here and over here as well. And when we put them in little by little, it feels like we're not moving anywhere. So what Dave Ramsey suggests is he does what's called baby steps. There's 7 different steps in there where he takes you through each stage. So 1 is setting up a small emergency fund. Number 2 is paying off all debt. Number 3 is building a little bigger emergency fund. And it goes on and on. So these are 2 great strategies to help you budget to find extra money. If you don't have extra money available, then it's not going to be easy to pay down your mortgage because we need money to do that. So we need to find the extra money that's slipping through the cracks in our budget and get on a little bit tighter of a budget to pay down our mortgage. Okay, now what are some solutions? So I have 4 different solutions here that are some of the most common ways to pay down your mortgage. I have all the links to the calculators I'm about to show you here in the description if you want to put in your own mortgage and your own situation just to see what this would look like. But the first option is to do a lump sum. So this would be if you had a bunch of cash and you said, I want to take this money and put it directly on my mortgage. So let's say you had $10,000 and you want to say, I want to put all this on the principal of my mortgage to pay it down. Maybe your mortgage was $150,000 and you're paying it down to $140,000. Okay, so let's run through what that would look like. So I use this calculator to do a $10,000 lump sum payment on a $150,000 loan. So what that did is I can see it saved 3 years and 3 months. So we paid off the mortgage 3 years early, and it saved $18,500. Okay, that's some pretty good savings. We put in 10 grand to pay that down, and we got $18,000 in savings. So you kind of have to weigh that. Is that a good option for you? So lump sum might work maybe if you get a tax refund, or maybe you get an inheritance or something like that happens. Lump sums are a little bit rare though, just because normally people don't fall into a whole grouping of cash that they're wanting to pay on their mortgage. The next one is probably the one that has the most controversy around it, and this is bi-weekly payments. I hear a lot of people saying, do bi-weekly payments or one extra payment a year, and you're going to immediately cut off 10 years off your mortgage or something like that. So people just make up random numbers, it seems. And the math can sometimes work out where you save money, but it's usually not going to be 10 years. So bi-weekly payments work because what ends up happening is, since you're paying bi-weekly, you end up paying 26 payments per year. All right, so instead of paying 24, you are paying the 26 there. So the benefit of this is you have one extra mortgage payment per year. So one extra mortgage payment that's getting added into paying off your loan. So if you did bi-weekly on a $150,000 loan over 30 years, we can see the interest difference here. And that saves you $17,000 and 5 years off of your loan. Okay, so it's not a bad option. It's going to save you a good amount of money, and it didn't really cost that much in terms of how much you have to flex. So you're not getting this huge payment shock of saying, I always have to keep sending in more money, but you get a good amount of savings there. Another one, this is probably one of the better strategies, is just simply paying extra money each month. It sounds simple and it's not super exciting, but it works probably the best out of these three strategies. This is just putting extra money every single month on the principal of your mortgage. So, a lot of people like to think of the example of, if you spend $5 a day on coffee, what if you took that money and put it into your mortgage? Okay, so it's $150 a month. What would it look like if we did that? So in this example, I have a $150,000 mortgage, and I'm saying we're going to put in $150 per month towards the principal. And so what that does is that actually saves us 8 years and 5 months and almost $34,000 by putting in just an extra $150 a month into our $150,000 loan. That's some incredible savings for just an extra $150 per month. Okay. The last option here is to refinance to a lower rate. So the lower that your rate is, that means the more your monthly mortgage payment gets paid towards the principal instead of the interest. So this is going to help accelerate your payment as you continue paying it over the years. Something you want to watch out for with a refinance is that you don't take closing costs and wrap it back into the loan, right? You don't want to take a $150,000 loan, refinance it, and then refinance it to $153,000 because you had to wrap closing costs into your loan. Because you spent time paying off that loan, you don't want to increase its balance. So it's something to watch out for on a refinance. Also, you want to make sure when you refinance to a lower rate, if you, let's say you have a 30-year loan and you're 2 years into paying it, so you have 28 years left, don't refinance into another 30-year loan. You just re-stretched out that debt an additional 2 years for no reason. Just refinance it to a 28-year loan. You can do that. It can be odd numbers if you want it to. All right, so some last things to watch out for here. Maybe. Okay, so watch out for a prepayment penalty. So when you set up your loan in the very beginning, when you first got it, on your loan estimate, your closing disclosure, it was going to tell you if you had a prepayment penalty. A prepayment penalty is where you get a penalty fee charged to you if you pay off your mortgage early. Now, most newer loans do not have prepayment penalties. Sometimes older loans can, just because the era in which those loans were given, sometimes the terms were not super beneficial to buyers long term. Also, if you have loans like portfolio loans, or loans that aren't very standard conventional or FHA loans, they might have a prepayment penalty that you need to watch out for. So know that going in, because you want to see what that penalty is and see if it makes sense for you to pay off your mortgage, or if there's a time limit that you need to wait. Also, you want to weigh kind of the pros and cons of, do you pay this money into your mortgage or do you invest? Right? A lot of people run the argument of, well, I could pay it into my mortgage, but my mortgage is only a 4% rate, where my investment account is averaging 10%. So is it better to receive 10% over here or to pay down the 4% debt over here? And sometimes it's more of an emotional decision than it is financial. Sometimes it's nicer to not be leveraged and to be able to have a home paid off. And if that's you, that's perfectly fine. Not everything has to come down to these dry, cold numbers, but just weigh kind of the pros and cons of, you could invest that money or you could pay down your mortgage. It really just depends on what's going to work long term for you. Also, you want to be careful to not get cash poor just because you want to pay down your mortgage, right? If I have 10 grand in the bank, I don't want to take 9 grand of that and throw it towards my mortgage, because then I don't have liquid cash in case an emergency comes up or something else happens where I need that money. So don't take all of your money and keep throwing it into the mortgage every single month if it's going to be tight for you, if you need cash, and if you need some emergency funds set aside. All right. So this should give you a good idea of some ways to pay off your mortgage early. If you have any questions, let me know. I'd love to hear your feedback in the comments or some other suggestions that you have on paying down your mortgage early. Thanks so much for watching.